everyone, I'm your host David Fraser and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to make you, our listeners, more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in be boring, make money.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Welcome to another episode of the Art of Boring podcast. Thanks for joining us today. Today we're doing playing the Plan edition with John Wilson, who's the co-manager of the Global Small Cap Fund. John, thanks for joining me today.
Thanks, Dave.
The world looks a little bit different from the last time we had you on, which I double-checked was October 2019. So looking forward to hearing your thoughts today.
Absolutely. Happy to be here.
So we're hearing a lot about inflation these days, and we've covered this topic on the podcast already. But in terms of global small cap land, how do you think about that risk in that environment?
That's a good question. I think you're seeing a lot of talk of inflation, especially anyone who's thinking about doing renovation. I think they've seen lumber prices spike, so there's a lot of headlines out there. So it's something we spend a lot of time thinking about. In terms of the portfolio, one of the things that we try to do to guard against that is we're trying to invest in a basket, so a diversified basket of companies that have pricing power. I think that's actually an important attribute that comes out of the businesses that we like to invest in, which are companies that have moats. If you have that pricing power, one of the benefits is that as you find your raw materials increase, you're able to eventually pass that through to your customers. And it might not happen overnight, so there might be a bit of a lag, but eventually we think that if you have pricing power, you should be able to get that through. The one that stands out to me in our portfolio that would fit into this category, and it's one of our larger weights, is electrocomponents. So that's a company based out of the UK that's a long-tail distributor of components. It's important to note that word long tail, that means that they basically have a large swath of inventory, over 500,000 different individual SKUs or types of parts. And that is really a function of the type of demand that they're trying to meet. Oftentimes, the customer is in a situation where a machine's broken down, they're sitting around waiting for this one part to basically fix the machine. So the customers are highly, highly time sensitive, but not very price sensitive. So instead of charging $50, which is the average basket or average cost per item, you charge $55 or $60. The customer doesn't really care. I mean, when we've done scuttlebutt on that company, which is something we do for all our investments, where we try to talk with customers and competitors, one of the customers mentioned to us that they've had instances where they'll send a part down in a taxi cab. So highly, highly time sensitive, but not very price sensitive. And we think investing in those types of businesses over the long run will help with a lot of the inflation that we're seeing in headlines these days.
Yeah, so crucial parts that they need right away so that companies are able to pass on the increase in costs there. Is that something that's known in the market? I mean, are we paying a higher price for those type of companies knowing that that's a good benefit of owning a company like that?
I don't think so. So I think that a lot of people will classify distributors and they'll kind of use a broad brush across that entire category. And they might not dig into the minutia or the details around the fact that this is a long tail distributor. So I think that's one part. They might miss it. I think the other part is if you think about that business model, it really hasn't encountered a lot of inflation historically. I think there's a very logical reason on why they have pricing power, and we've gone through the research of trying to understand that better. But I think a lot of times people won't ascribe that value to that until they actually see it. So I think that might be an area where the market might not necessarily appreciate how much pricing power they actually have, because we haven't had an instance like this for 30, 40 years where you're seeing a significant amount of inflation.
So it sounds like that might be an embedded benefit of our type of investment approach, where we're looking at the fundamentals and really drilling into these companies perhaps a little bit more than others who look at things from a little bit of a higher level.
Absolutely. And I think that comes back to the time horizon that we have. Like, if you think about it, there's stats around the average hold periods, I think a year. If you're holding a company for a year, are you going to spend time talking to 3 different customers and go out and try to understand the competitive advantage really deeply? Probably not, because you're going to be selling it within a year. So that investment that you make in that research probably doesn't make a lot of sense for you to do. But for us, when we hold our companies for 5, 10 plus years, it makes a lot of sense for us to do that research and spend a lot of time trying to understand these moats and this pricing power in a very detailed manner, because we're planning on holding it for a very long time.
Yeah, absolutely. That's great. That's great insight. And as the world becomes more and more digital, we're seeing more headlines about cybersecurity. How do we assess those types of risks when we look at companies?
A lot of headlines around this one over, especially the last 12 months, we've seen a lot of ransomware attacks or cybersecurity issues. So the way we think about that is we're often thinking about it within our ESG framework. So that'd be one of the social risks around customer data being leaked. And we think that impacts all of our businesses, but in particular, we think it's particularly impactful for IT-related businesses. So IT consultants, we have a business model called a value-added reseller, which you can think of as outsourced IT department. We think those business models are even more impacted by it. And you can just think about it logically. Customers are coming to you to provide advice on cybersecurity, and then you have a breach. Then that impacts a lot of your credibility that you have with the customers. Like, how good is this company if they're giving us advice on cybersecurity and they get compromised? So we spend a lot of time trying to understand, first of all, have they had breaches historically? So talk about instances in the past. So that's more a output. And then we try to figure out the input. So, okay, so you haven't had breaches in the past. Let's talk about the process that you have around that. How do you ensure that customers' data is protected? So, for example, one of the companies we have in the portfolio is a company called Softcat, and it fits within that value-added reseller category, so that outsourced IT department. And what they'll do is they have white hat hackers, so they'll basically come in and they will try to penetrate their systems. They'll do that to make sure that if someone was trying to get in with kind of a bad intent, they try to find the vulnerabilities in their systems ahead of time before that happens. So we think they have a fairly detailed and well thought out process around cybersecurity. We think that's becoming more and more important.
So as we weigh up these risks of certain companies, either inflation or cybersecurity or anything else really, how do we decide how much time to spend on new ideas or new companies that we might want to add to the portfolio or reevaluate holdings that we already have?
One of the things that we're trying to do here, and one of the big focuses we have, is on capital preservation. So that's where we start when I think about answering that question. And so what do I mean by that? That means the companies that we're invested in right now in the portfolio, we need to do a certain baseline amount of research. So we need to make sure that the foundation that we have, the companies that we're invested in, are solid. That's how we've chosen to set the bar. And so that involves every year we're doing a refresh report on that, where we're talking to either competitors or customers, doing risk screens and updating the DCF, putting out a report. So we think that that is where we start. And once we have that complete, then the remaining time we spend on new idea generation. Fortunately, because of a process that we use called the reverse roadshow, which is effectively meeting a number of companies in a 1 week time. So rather than spreading it out over maybe 3 months, we'll spend an entire week or 2 weeks talking to 20, 30 companies. That allows us to have a very high throughput on the idea generation on new companies. So we find that it's a good balance right now, and that process certainly helps with idea generation.
On the reverse roadshow, I believe that you're sort of conducting one at the moment. As you say, you're out there meeting with a lot of companies in a very short amount of time to get a better sense of things. Have you had any learnings from the most recent version of the reverse roadshow?
You're right. So we're in a roadshow right now. We're just coming to the tail end of it. One of the things that we like to do is to experiment in these roadshows. So we'll trial new types of questions with management teams to see whether we can get new types of insights. And so I'll give you a couple of examples around that. The first one would be, the question is, if you were to stop investing for growth, how would that impact your margins? The thought around that, why we're asking that question, is we find that oftentimes the accountants haven't kept up with new business models. So historically, you'd make these investments in a big factory or plant, and that would show up on your balance sheet, and you'd spread the cost of that over the life of that asset. Well, today, a lot of expenses, a lot of these investments are actually happening on the income statement. So what that means basically is your margins are a lot lower than they would be if this was properly accounted for, if it was actually capitalized and amortized over time. So that can make a company look like it's actually not earning that much profit. when in fact, it's actually quite profitable. There's a great podcast Justin Anderson did about a year ago, listeners can check out, on this exact topic. That question effectively makes sure that we're not missing those opportunities. And an example of a company that we had an interesting answer to around that was a company out of Switzerland that is a broker. So they allow customers to buy and sell securities on their platform, and they invest a lot in new product development. And when we went through the math with them on this question, we think that their operating profit would actually be about 40% higher if they had properly accounted for these investments and actually capitalize them. So that is actually meaningful, and it might look like this is not earning that much, but when you take that into account, you realize, wow, that's actually quite attractive. So that'd be one example of a question we're trialing in these roadshows. The other one is, one of the areas that we find can be mispriced in the market is just the quality of a management team. If you think about why that might be the case, there's a certain art to assessing management. And I think oftentimes if you look at sell-side research, so this is research that is available to everyone or a lot of people, they don't spend a lot of time talking about management. They might give a quick background, but not a lot of detail. So we don't think it's necessarily well known or something that's focused on a lot. So one of the questions that we're asking around that is, what are you doing differently than competitors? Why is that important? Well, oftentimes when you're doing something different than competitors, it means that you've probably thought about things from first principles. So you started basically from the ground up and thought about, okay, what are we trying to accomplish? I mean, one of the greatest examples of this, in my opinion, it's not a small cap any longer. It hasn't been for a while, but Costco, they can walk you through the full model. So rather than use the Walmart approach, which has a number of different items on the shelves, they decided to go with a limited number of products. Well, why did they do that? Well, because with each of those suppliers, they have more bargaining power because they're buying more of those products from each of the suppliers. And then they'll tell you, we're going to have actually a lower markup than all our other competitors out there. Oh, why did you do that? Well, that drives more customers to the store, which gives us even more bargaining power with our suppliers, which then drives more customers. So it's had this virtuous cycle. So just by asking that question, what are you doing differently? You can get these really interesting case studies of management teams that have really thought about things from first principles, and that can present a very interesting opportunity.
Yeah, absolutely. It seems to me, again, it points to that benefit of having that longer term time horizon where we want to hold these companies effectively into perpetuity if they are solid businesses. And that's an added benefit of that approach, where another investor might not want to spend the time drilling that deep to understand the business that well because it's not worth their time, as you say, over that 1 year holding period.
Absolutely. And the things that drive, I mean, you think about on the management side, culture is a big driver of long-term performance. It probably has next to no impact on the performance of shares over the next 12 months. So it's just items that are just not focused on by the majority of investors.
And obviously travel's a little bit more difficult these days. I don't think on our research team we are traveling a lot at all. We used to get out there, we'd see factories, we'd see warehouses, we'd meet with management teams in person, get a good sense of that business from a first-hand approach. How hard is it these days, and what have we done differently to try and get that sort of information now that we can't travel as much as we could?
Yeah, you're absolutely right. That's one of the things that we try to do a lot. We call it scuttlebutt or on-the-ground scuttlebutt. We don't just take management's word for things, but we want to check it out ourselves. So in terms of the pandemic, you're right, it has impacted the amount we've been able to get out. But what we've been able to do is we've been able to substitute in other options. So using expert networks is something that we've been finding has helped a lot. So this allows you to reach out to customers and suppliers and prior employees of the company. That can help get you a good sense of the business, the underlying business. I think it's also important to note that when we think about our edge or advantage in the market, what we're talking about right now is informational edge. So we're talking about something where we have information that is unique or gives us an advantage over our competitors. I think there is a certain amount of weight and importance to that. I think other edges or other areas that I think also matter equally, if not more, is that there's a behavioral component. So part of that's patience. So focusing on companies that might have a short-term issue. Again, that 1 year time horizon investor just not interested in taking the risk over the shares may be down over the next 12 months. Well, we're very interested in doing that if we think the long-term outlook looks good. And you can also see it from an analytical standpoint. So we fit the pieces of the puzzle together, maybe a bit different than other people, probably again relating to time horizon, as well as some of the tools we have internally, whether it's how we frame decisions in terms of the matrix, whether it's the database we have of, we call it M42, but basically all past company notes from not just within, in this case, global small cap, but across the entire platform. There's these other areas that can give us an edge over the others in the market. We think that they're equally, if not more important, than informational side.
Yeah, absolutely. And speaking of edge, from all of this research, are we seeing any mispricing in the market where we're taking advantage of things anywhere in particular?
I would point out kind of three general patterns. One, I just mentioned around short-term concerns. So a company we invest in around that is, it's a car dealership out of Sweden called Bilia. And what happened in November of last year, so November 2020, was they have a large contract with Volvo for selling Volvo cars. And Volvo effectively gave them notice that, hey, over the next 2 years, we'd like to sunset that contract, terminate the contract. And so the shares are down a significant amount. And I think that created some uncertainty. So what we did was we actually dug into the contract to try to understand what that actually involves, what that actually means. And what ended up happening at the end of the day was that contract is only for new cars. And new cars actually have a much lower margin than used cars. And then on the used car side of things and on the service side, so servicing Volvos and selling used Volvos, that's something where Volvo would actually not be able to take that away from them. That's something that they actually don't have the ability to do that given the legislation in the region. So that was one where after we did our research, we thought there's probably an impact on profitability, but given the size of the sell-off and the valuation at the time, we thought it was attractively priced. So that's something where there's this short-term uncertainty. The other one that comes to mind around that is a company we own in Japan called Broadleaf. So that's a company that does ERP software for garages there. So the garage needs to be able to manage their accounting system and manage their ordering system. And so that's what Broadleaf does. They're switching from a license base where they get all these fees up front. So if you think back in the 1990s, you'd buy your Microsoft 95 CD-ROM and you'd pay that upfront fee to Microsoft. Well, today you pay this recurring fee. What's important to note is that when you go from getting all that revenue up front to spreading it out over time, you get an initial revenue hit where your revenue's down and impacted by that. But over the long run, it doesn't matter. It's a wash. So we think that that's something that, over the next couple of years, they're probably going to face pressure and difficulties. But over the long run, we think this is absolutely the right area and right decision for the company. A few other areas that we find that there's some mispricing. The first one is just around the overall runway that some companies have. So oftentimes when people talk about valuations, and I'm talking about sell side valuations, oftentimes they might do a forecast for 2 or 3, maybe 5 years, and then they'll stop forecasting and they'll do either a terminal multiple or some sort of terminal calculation. Basically, what that does is it only captures a short amount of a company's runway. Now, this doesn't apply for all companies. Some companies, there's a lot of uncertainty around growth, but this mispricing does apply for companies that we think have cookie cutter growth. So that's growth that's very high probability that they're successful in capturing. So the one that comes to mind there is 4imprint, and that's a company that does promotional products. So if you think about buying a pen or a water bottle, I have this lovely mug that says Mawer on it. That would be also something that 4imprint does. It's run by a fantastic management team there. They might have 3% of the overall market, but they've been gaining share against largely a collection of small competitors that don't have the resources to invest in their websites and sales process. So we think they have a very long runway. We anticipate that might be mispriced by others looking at the company. And the final one I'll just touch upon briefly is what we call owner-operators or engaged owners. So that's the idea there is there's a management team in place that is also a large shareholder in the company. And a great way I've heard someone describe this recently was when the toast falls off the table, when you have an owner-operator, it always falls butter side up. So it's when something happens, they're able to mitigate risks before they happen and actually capture optionality. So when there's an opportunity, they jump on it and think about why that is. Well, they have 90% of their net worth tied up in the company. They spend a lot of time thinking about these things. So we think that that's also an important pattern that might be mispriced.
That's great. So thanks for pointing out those areas where we might be able to find an edge. And I appreciate that requires a lot of hard work as well. Teamwork's a big part of what we do and doing that type of research. So as you work with new hires and summer interns, can you talk about the process involved in incorporating them into the team?
That's a big area of focus for Global Small Cap and something that we really have a passion around. So when people start at Mawer, they start in Global Small Cap, on the Global Small Cap team. And right away, they're assigned a coach. And that coach meets with them on a weekly basis to help them get up the learning curve, answer any questions that they have. Oftentimes, there's coaching around particular mental models that we use in investing. What is customer stickiness? Let's talk about the attributes of that. What sort of questions can you ask to assess that? Things like that. They get assigned a coach. On top of that, all of the research that they put out, we have them write research immediately. We think that that's important, that if you're training to do something, you should actually get reps on doing that thing right away. You shouldn't just sit around and read books or do these theoretical things where you think you should get your hands dirty. So all the research that they write will get feedback from all the portfolio managers on the fund. So they're getting multiple sets of feedback on each one of their reports. There's also, because one of the key things and one of the important things that we focus a lot on at Mawer is the culture piece. So making sure that people that are on board and understand the culture really, really well and live that culture. So in addition to everything I just said, we also have weekly sessions. They're effectively culture indoctrination sessions where we have these cultural videos that we watch. We'll go through that ahead of time, and then we'll have a discussion around that. And that ends with an assessment that is carried out on everyone that joins, where we basically say, hey, here are the attributes that we think relate to a high-performing investment team. And here's an area that you're really excelling in. And perhaps here's an area that we'd like you to keep focusing on. So all of this is everything I've just mentioned. It's all around giving lots of reps, lots of feedback, and making sure that the culture is in place, because we think that's very important to the long-term success of Mawer is making sure that people that come on to the platform are well-versed in all these topics.
Right, John. Well, thanks so much for giving us that perspective and talking about some of the risks we've seen out there, some of the processes we follow, and how ultimately we try and find mispriced securities out there. So very good to hear your thoughts today, and I'm sure listeners will take a lot out of that. So thanks very much for being here.
Thanks, Dave. That was a lot of fun.
Hi, everyone. David here again. To subscribe to the Art of Boring podcast, go to mawer.com. That's mawer.com/podcasts, or wherever you download your podcasts. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Thanks for listening.